All right, well, let's get started. Thank you everyone for joining and welcome to Talaria's quarterly webinar. I'm Al Reid, and before I hand over to Lance and Hugh, just a few housekeeping things. We have muted microphones and blocked cameras just to limit background noise and distraction, but you can use the Q&A function at any time to ask a question. We will come to them at the end. So I'll ask them on your behalf once the formal presentation is complete. So I shall now hand over to Hugh and Lance.
Al, thank you. Hugh, welcome. Another quarterly discussion. Plenty going on in a quarter. For those who have read the quarterly, I mean, the very opening sentence is, it's not what happens, but what's priced in. Hopefully today we can unpack that a little bit more. I think I'm often reminded the investment team talks about being keen students of history as opposed to forecasters. So hopefully we can give that a little bit more context as well. And, with so much to digest, if I was reflecting on the quarter, you've got cyclical considerations, you've got just general rise and uncertainty, and possibly even leading into some structural change. So there's a few moving parts. And with that in mind, maybe an actual good place to start is the end of last year. Perhaps give us a bit of thought in the year that was before we really get into the year that is.
Yeah, sure.
Yeah.
Thanks, Lance. Hello, everybody. Hello, listeners. So let's just contextualise where we came into 2025. Investors globally had never owned more equity. They'd never owned more equity in a single region, the United States, as you can see here on the slide on the left. And within that region, they had never owned such a concentrated subset of equities within that US market. So the way that we've been characterised that in the last webinar was this risk has been hiding in plain sight. Okay. So that was a function of where we came into the start of the year. Equities in that region, expensive, very widely held, in great concentration, both by region and a single security sort of situation. Now, of course, what's happened is we've seen a pretty sharp reversal of that in the first quarter of 2025.
Absolutely.
I would just remind everybody that it wasn't only really the change of administration and some of the policies I'm sure we'll touch on has moved the narrative on in markets and obviously had an impact on prices. But from that all-time high in early January, there had been a reversal already. So the very strong momentum performance that we saw in 2024 had started to reverse before we saw the market take fright about the policy implications impacting equity valuations and the outlook for corporate profits.
Yes.
So that's sort of what's happened. Of course, you can see here that concentration has reversed in terms of the United States, really by far and away the biggest contributor to a decline in overall global equity markets in the first quarter. So, that bug found its windshield, as we've got to say in the investment team.
Actually, it's an interesting one. And just to give context to that, so you mentioned the changes before some more policy announcements in the US. There was a particular day where you saw some interesting things occur. If you wouldn't mind maybe just stepping us through this basis risk.
Exactly. I mean, one of the issues about being so concentrated that we've been highlighting is that you're taking a tremendous amount of what's called basis point risk. Now, we're using the exhibit that you're looking at now is just a single day in late January. And for those that remember, on the 27th of January, on the right-hand side there, the S&P 500 was down about 1.85%. What's very notable, however, is across the bottom, there was 200 more securities went up on that day than went down. So in aggregate, when the market was down 1.85%, 350 of the S&P 500 was actually up on the day. And that's really a microcosm of the risk that you're taking with such big concentration. And of course, that could also have been an update, right? You could have had a very large up day where 450 stocks went up, but only 50 didn't, but they could be the biggest 50 in people's portfolios.
So that's a recent example. On the spot question, but casting your mind back, because basis risk isn't something that I think investors have front of mind historically. Anomaly, is there a reference point somewhere in the past where this has occurred as well?
Well, I'm loath to, absolutely there is. The parallel is about the basis point risk. I don't want to draw a direct parallel to the backdrop, but certainly that concentration of market leadership was similar. If you remember, global equity markets peaked in March 2022, March the 22nd, 2000. Right, in terms of the S&P 500, it didn't trough until September of 2022. The S&P 500 over that period was down well over 40%. And yet actually well over 40% of equities were actually higher in absolute terms over the course of that period. And that was a similar time where we started with an incredible level of concentration within the index.
Yes.
And so it shows that 4 out of 10 securities, despite a market being down over 40%, were actually up in absolute terms. So that's the kind of, that's the exciting thing from an opportunity point of view, but it's also the risk that people in aggregate globally are running with such concentrated portfolios.
Yes. And I suppose pointing typically, given the exposure to index strategies as well, this is the pointy end of that.
It's 100% what that is. Absolutely. Yeah.
Hey, over the last few quarters now, the investment team has really had a bit of a focus on earnings risk. It's been a theme embedded in a number of the quarterlies you've produced as a crew. Perhaps giving us a bit of a feel for earnings risk.
Well, what we've seen obviously is that markets have sold off in the first quarter, particularly the US market, as we just highlighted. So there's been a lot of multiple contraction. What we haven't seen yet is a change really in earnings expectations. So currently consensus forecast is for 11.5%, 12% earnings growth in the US over the course of 2025. Clearly the market, by derating the equities, is suggesting potentially that those numbers are wrong. And I'm sure we'll get onto that. What we're looking at here in terms of the slide is simply a range of scenarios in terms of the individual sector valuations, just on a straightforward PE for 2025 versus the yellow dot, which is the average PE for that sector or indeed the market. So let me talk you through, for example, on the right-hand side, the real estate market. The current consensus forecast leaves the real estate sector on about 17 times PE. That's that grey bar on the far right-hand side of this exhibit. If the EPS growth in the real estate sector was to be 0, then that would push up the multiple very modestly, which is the blue bar, because you can see actually the real estate sector is not forecasting a lot of growth. And indeed, if 2025 was to end up with a 10% decline in terms of earnings from where people have been forecasting it at the start of the year, then that would leave the teal bar, the sector, on about a 19 times PE. And you can contextualize that with the yellow dot, which is the real estate sector's 10-year average PE. So I think the key point here is, in aggregate, the S&P 500, which is the fourth group from the left, you can see that the market has actually derated considerably from when we presented this chart in the last quarterly. So it's now trading at around about 18 times PE in terms of current 2025 estimates. If those estimates were to prove 10 or 12% too optimistic, so we end up with 0 earnings growth for the S&P 500 as a total, it would merely be in line with the 10-year average, even though you'd be seeing a real deceleration, obviously, in the outlook for profits. And if we see a decline in earnings of 10%, then actually it's left at about a 20% premium or 15% premium, the overall market, to the last 10-year average. So I think we've moved from risk on valuation, which we talked about over the last webinar, to really the markets recognizing that it started to adapt with the reversal of momentum, and now obviously with subsequent policy developments around the world calling into question the outlook for corporate profits. The next real move here in markets is going to be a function of what is the earnings base. Great thing last night, when we're obviously in the middle of earnings season at the moment, and I haven't really seen this before in my career, United Airlines, for example, gave 2 outlook statements in their results last night. In a normal business environment, they said that we would earn, at the midpoint around $12.50, or if there's a recession environment, actually we're going to earn about $8. So it's really putting it back in the investor's mind, which do you think is going to happen? Earnings will either be $12.50 or they'll be 40% lower. As someone quipped in the investment team this morning, welcome to the airline industry. But I think it contextualizes what we're seeing. I mean, Walmart has withdrawn their guidance. We've seen a number of companies start to say we're not prepared to give you forward guidance about the profit outlook for our business because we're simply not in a position to know. So to be buying today, you're effectively saying, I know more than the corporate. And that I think that the outlook for profits is going to be better, not worse, in a fairly uncertain environment. That
Definitely.
And that shows you the payoff on that if you're going to go back to a 10-year average PE.
So certainly quite unique. If I take my mind back to the earlier comments about the investment team being keen students of history, perhaps even if we take a step back and think about where we are in the sort of tightening cycle, or end of the tightening cycle, your sort of comments, where we find ourselves today relative to previous cycles.
Yeah, I mean, what you're looking at here on the exhibit we've shown before, remember, I think I'd mentioned on the last webinar that consensus only came about in the early 80s, so we've only been able to track the evolution of the full 2-year outturn of corporate profits relative to consensus once the 2-year yield has peaked. Now, we use the 2-year yield peaking as a proxy for a move into the easing cycle, the interest rate easing cycle. So let me just talk you through this exhibit slightly. The teal line is the average outturn of the full 2-year forward earnings forecast from the moment the 2-year yields peaked to the subsequent absolute outturn. And you can see actually that at the moment the 2-year yields peak, the market on average has been about 24% too optimistic about the outlook for corporate profits and the ability of an easing cycle to boost corporate profitability. What you're then looking at is the 3 scenarios since we peaked in interest rates, the 2-year yield in October of 23. So effectively, the full 2-year forward would be the end of 2025 in terms of the current trajectory. And what's interesting is the S&P 500 equal weighted earnings outlook, which is represented by the yellow line, is completely on track with the historical delivery of those 6 easing cycles. In the example of the previous exhibit where we talked about 0 earnings growth, that would suggest that that line would need to drop another 10% once, or a little over 10%. So if you were to have a 10% earnings decline by the time we get to the end of 2025, which was the 3rd scenario we had there on the previous exhibit, actually you would end up at that 76, completely in line with the historical delivery. Yeah. And of course, the reasons for that are always different. But it does contextualize that it's whilst history is never exactly the same, it quite often rhymes. And so far on the equal weighted index, it certainly is. Small caps, as we've said before, are the equal weighted 1500, quite a lot worse because of the interest rate cycle really crimping the bottom line corporate profits of those companies that are much more reliant on shorter term funding. And of course, the S&P 500 index, which is the dark blue line on the top, really driven by a fantastic profit performance over the course of 2024 by some of the largest companies in the index, notably the likes of Nvidia and so on, and that has kept the overall S&P 500 above the historical delivery so far.
Right. Dragging you back actually to an observation you made now, I think a few months ago, around the skew, if you will, of market preferences for falling bond yields. I found that really interesting. Would you mind gently kind of taking me through that skew as you see it?
Yeah, absolutely. So I think you would be familiar, and a lot of people listening now would be familiar with, we're not in the business of forecasting. You're making decisions under uncertainty. So it's really only about odds and probabilities. And the first lesson I learned coming into markets was it's not what people say, it's what they do. Okay, what you're looking at here in the exhibit is the percentage of global market capitalization in equity markets that is positively correlated with bond prices. Okay, so when yields fall, so bond prices go up, then 70% of the market cap of world equities is positively correlated to that. Okay. Now and that's up from about 10%, as you can see, as recently as a little over 10% in 2020. But really, the historical range has been in that 10 to 30. We are currently over 70%. Now, the way that I would characterize that, Lance, is that you need to have a view that bond yields will fall, the bond prices will go up, to a confidence level of 70% or greater, to also be comfortable, if you represent the entire global equity investment universe, that the equity market is actually is right. So the issue here is that odds of 7 out of 10 says that bond yields are going to be falling, so bond prices are going up, and of course we've seen in recent weeks they've been actually rising. If you're less than 70% confidence, then the makeup of your global equity portfolio is wrong, is how we kind of characterize that. Does that make sense to you?
It does. It does. It's I mean, in a world of, you mentioned the duality of reporting in a 50-50 outcome, when you have 7/10 going one way, surely that flags a risk.
It's a huge risk for the market if they're wrong about the idea that longer term bond yields will fall. Absolutely.
Cool.
They are not diversified from that risk. They are voting with the equities they own in the size they own them, that bond yields will fall.
Which then coincidentally leads into an observation around the output gap.
It does. Listen, before that though, because the output gap says why bond yields might rise. I know we're going to come on to the longer term issue as well that we highlighted in the quarterly, but first off, there's some pretty reasonable historical precedents to expect that bond yields will fall, just to say that. So we're not in the business of forecasting, we're not arguing one or the other, but we're saying that there is equally compelling and competing scenarios that means that bond yields could fall or bond yields could rise. Now, the bond yields falling scenario is really that we have seen an increase in unemployment, interest rates, the supply of money, so M2, which is total stock of money, has been declining, which typically actually correlates very well with the outlook for yields. We continue to see the velocity of money, so the turnover is slowing. And we continue to see in certain sectors that there is excess capacity, okay, individually. Plus, probably the biggest elephant in that room is that China remains in a debt deflation. They are in a deflationary environment. We're seeing that in their official numbers, and they're exporting that to the rest of the world. So all of that would be commensurate with a normal cycle that you would see interest rates and bond yields fall. This exhibit that you put up now, Lance, is really showing the counterfactual to that. What you're looking at here is the US output gap, and that's advanced about 12 months. So you can see that's the dark blue line on the right-hand side. What is the output gap? It's simply the total available capacity in terms of production capacity versus the total consumption of that capacity. So think that an economy can produce 100 widgets and 98 are being consumed. The output gap is 2. If 100 are being produced and 100 are being consumed, clearly that has an implication for inflation. Because if you can't produce anymore, but demand is there, clearly producers will put up prices. Now, the reason, in very simple terms, that central banks increase interest rates is, of course, to dampen down that demand, to open up the output gap. On the right-hand side here, that dark blue line, you can see that actually despite the US Federal Reserve increasing interest rates over 500 basis points, there has not been a significant reduction in the output. Okay, so that is saying if the lagged impact of monetary policy, so the interest rate cuts that they've seen, and they flow through into the economy, if there's going to be a re-acceleration of any sense in the US economy, that on the margin would be inflationary. Okay, so the traditional role of monetary policy to open up the output gap has not occurred in this instance, and that leaves the backdrop pregnant with possibility that in a better demand environment, inflation, all else equal, would go up. So that's the counterfactual in terms of why one might be concerned that inflation will remain higher than the Fed's target, and obviously will not contribute to bond yields falling from a cyclical perspective.
Perhaps before we almost take a step back, and that's certainly the shorter term, to give context to my next question, perhaps if I could, for the fear of being misquoted, call out a statement that was quite firmly made in the quarterly. And if I recap, of all the messages in this report, this is perhaps the key strategic observation we'd like to convey, that nominal growth and the cost of capital are no longer diverging, reversing a trend that dates back to the early 90s. Consequently, dismissing valuation and adapting a set and forget mindset is no longer likely to be the answer.
Well, I'm very glad that you called that out. Obviously, the quarterly went on Monday. There is a huge strategic challenge for all of us as investors in the sense that I think on the go-forward basis. In very simple terms, if you know the cash flows of an asset, you know the cost of finance associated with that asset, and you know the return you want to get from the asset, so the discount rate, then you know exactly the price for that asset. Okay, now clearly, in the real world, that's a lot more complicated than it sounds, but if you know the cash flows of an asset, you know the cost of finance, and you know the return you want to get from that asset, you know exactly the price of that asset, which will give you that. What's happened and why we've circled that early 90s period is that over the last 30 years, as globalization took hold, because remember at that period you had two things. You had the fall of the Berlin Wall, which meant that about 350 million people came into the workforce in Eastern Europe.
Yes.
But equally, Deng Xiaoping had a very famous visit to the special economic zones in China, where he said that explicitly wealth in and of itself was not a bad thing. And that was in 1993. Now, with that rise of globalization, what that has done is two things. One, it means that the cash flow growth in that valuation component has been better, right? Partly because nominal growth globally has benefited from globalization, but secondly, because the costs have come down significantly, obviously, for a lot of the developed market equities. So despite the tariffs, for example, US labor is, going to be 40 to 50% more expensive than, Vietnam, India, China, Cambodia, okay? Even with the tariffs that they put in. So you can see how that cash flow has been much better than people would have anticipated in, each iteration over time.
Yes.
But the second thing that really has been important as well in that globalization is that the cost of finance has been lower, because dollarization and the recycling of these huge trade surpluses back into the cost of finance has suppressed that from a long-term perspective. All of that has allowed assets of all types to get more and more expensive.
Okay. And that's been a continuing trend, right?
It has, and one of the notable things, well, we can show that actually.
Yeah.
So, Lance, what we put together here is simply just a visual representation of that, okay? The key thing, if you've been investing for the last 30 years, is yes, equities had 50% drawdowns in that period, but as long as you could hold your position, they have simply got more expensive over time, as represented here by the Shiller PE. And you can see the 100-year average is 16, the 20-year average is 25.7. The current Shiller PE is actually higher than that because we had a bounce last week. It's about 37. Likely, same in real estate, it's just got more expensive, and you can see high yield bonds have got more expensive as represented by the credit spread. So they've got tighter and tighter. That has meant that all savers have had a tailwind over the last 30 years. That has meant that assets have simply got more expensive. The same assets have got more expensive. Now, one of the reasons that we made such a strong statement in the quarterly is that has meant increasingly over my career, over the 25 years of my career, less and less people use valuation as part of their process. They say, well, do you know what? I mean, everybody seems to know about liquidity and, the Yellen drawing down the target reserves and, reverse repo, and basically that is the wrong thing to have taken away from that. So rather than say, well, you can talk about Schiller or you can tell me real estate in, Vaucluse has got more and more expensive. It's just always been true. It's if I'd listened to you about valuation 10 years ago, I would have missed out on X, Y, and Z. Our point is that people are taking the wrong conclusion for that. And the conclusion is this. You have to ask yourself, why has that occurred? And are the conditions that have allowed that to occur still in place? Not say, well, actually, valuations just got more expensive, and therefore I will pay less attention to valuation, which in aggregate is what the industry has been doing. So that's why we've made that statement, because I think the times for that, we're in slack tide, or worse, we're going to move into a period where there's actually a headwind to assets getting more and more expensive on a go-forward basis, and that will really change the return outlook. I mean, it's pretty amazing, right? I mean, if you think about a US portfolio of 60-40, we were talking about this 4 or 5 years ago, if you look from the start of 22, you've got 2% per annum in a traditional 60-40 portfolio in US assets, and US assets have done better over that period than every other region.
Yeah.
Okay, that is what you've got to today. That's 39 months and counting. Well, that is well below CPI. Okay, this is happening, I think, already. So it might be worth unpacking that.
Definitely. Well, I mean, a good thing to almost unpack as well. We closed last year with momentum as a factor, having quite a significant run. Just thinking about being appropriately compensated for earnings and maybe even the stability of earnings. We have noticed some interesting things occurring in a different factor, which is stability, and maybe even give us some context by explaining stability as a factor, and then kind of why you've seen this recent change.
Yeah, I think this is a good place to potentially think about opportunities, and then maybe we can touch back on that longer term, because people have obviously been asking about that implication of the headwind.
Yes.
So what we're showing here, Lance and listeners, is the top quintile of stocks as measured by the most stable earning streams, the most visible stable earning streams. That's really the volatility of your cash flow. So go back to the valuation point I was making. These are the top quintile of stocks in terms of the most confidence that you can forecast the cash flows into the future. Okay. Now, given that, if they're most stable, you know the return you want and you know the cost of finance, that's typically they trade at a premium. And the reason for that is just human nature. You have the most confidence about that valuation. You think about a security where the cash return perhaps is 12% per annum, but it moves between 0 and 30. Human nature says, well, I'm going to take a bit of a discount to that because it could be 0 for a few years before it hits 30, right? So let's just use an average of 10, not 12, or let's ask for a higher discount rate, a higher return to compensate ourselves for the wide range of outcomes. And that's why what you're looking at here is the most stable stocks in the market going back to 1976 trade at a relative PE premium to the market the majority of the time, outside of recessions. And that's partly because, the market goes to earnings collapse, so the market's on 50 times PE because there's no earnings and they haven't collapsed, and so they look like they're at a discount. So put them aside. But the majority of the time you can see that they're at a sizable premium to the market, anywhere between sort of 0 and 15% is a sort of running rate. Has been higher, obviously has been lower. But it's interesting, as we exited 2024, we were highlighting that the most stable stocks in the market actually were trading at a rare discount to the market. So I think in aggregate, that is an interesting potential place to look for ideas. Because of this cost of finance versus nominal growth shouldn't change. So if we go back to why that expansion's happened, the jaws have got wider. The cost of finance gone down. The cash flow growth's been better than we would have forecast because of this globalization.
Yes.
What we've been seeing since 2016 is really a move to the end of globalization. And that continued through the Democratic presidency in the United States. And of course, we've had a change of administration in November that has only accelerated that. And therefore, with a move to deglobalization, economic nationalism, countries and regions are starting to say, well, we may well have to use our private sector savings to advance our own agenda. Australia's a good example. We talked, I think, at length, you and I, before about, the Future Fund has changed the mandate so that private sector savings, these are public servants, that's their retirement money, it's their money. We're going to try and direct some of that money to the objectives of the government. Okay, and we're seeing that in the UK, where there's been moves by the pension secretary to pressure the savings and pension industry in the UK to put at least 10% of the savings pool into UK companies, be that listed or unlisted. There's about 370 billion of private sector savings that leave the European Union every year that go into US assets. Okay. Clearly, they're looking at ways to be able to retain more of that 370 billion to be able to advance Europe's economic and social agenda. There's pressure on the world's largest sovereign wealth fund, Norges Bank, out of Norway. Rather than hold 480 billion of US sovereign debt, perhaps they should, participate in a creation of European defence bonds. So these things are happening. A lot of people have asked us about, tariffs and the noise, and all we've been saying is, anchor to the long term, and the long term is to suggest now that tailwind to valuation could well be at an end. At the very least, that it's not going to be a tailwind, and worse, if we continue to accelerate this move to globalization, it is likely to be a headwind to the price of assets of all sorts over the coming extensive period. That's not going to help you quarter to quarter, but it will make a big difference point to point.
Yes. One thing that is a noticeable change, just thinking about the environment through the course of last year, and I think people have just experienced that firsthand as investors, and that's the volatility regime. So we'll dig in a few ways. We'll take a few angles on volatility, but on that rapid rise, you and the team did some work again, keen students of history, thinking about how to distill and process a rapid spike in volatility. Your thoughts on that?
Yeah, so we're very lucky, obviously, having only run one strategy for an extended period of time. We actually can kind of look at our own experience of the strategy. So the history is actually, what's transpired historically in the strategy. What you're looking at here is the 5 previous episodes where volatility as measured by the VIX has gone through 40 in the fund's history. Okay, and across the bottom there is the number of trading days until that volatility reduced back down to 20 or below. Okay, and you can see a couple of things, where it spikes to is quite different. The peak there, as you can see in the COVID crisis, the dark blue line over 80, for example, an all-time high. But if you have a look at the China devaluation, actually it was below 20, only a little over 30 trading days later, compared to the GFC, where it was 300 and well over 300 days later, trading days before the VIX went back down to 20. So this shows you the magnitude and then the duration until you fall below 20. Now, the reason that we were showing this, of course, is what does that mean in the makeup of the Talaria strategy returns? Because, of course, we're not just dependent on the capital component, albeit that has been a positive contributor, obviously, on the 1, 3, 5 and 15 years of the strategy.
Yes.
But clearly we're not reliant on equity markets going up to be able to generate a positive return.
Well, maybe even let's dig into that. I mean, the takeout before leading into the next question is obviously the Easter break is not going to be sufficient to abate volatility. It'll be here perhaps in a couple of weeks' time. But just thinking about previous periods in time and harnessing that volatility as a strategy, maybe if we could just talk to each of those periods and how that actually influenced the option premium.
Yes, absolutely. So clearly, I think we might touch on it, but we benefit from higher volatility because we get paid more for doing the same thing, and the opportunity to deploy capital can change very quickly, even if the share prices didn't change. Okay. What you're looking at here is the previous 5 episodes where volatility went through 40, and then the subsequent 6, but focus really on the 12-month premium generation in terms of our second lever of returns. So you can see in the flash crash and the China devaluation where, it returned to below 20 in the quickest instance. We were able to generate, I think the lowest was about 704 basis points of return over the subsequent 12 months from our implementation. But it goes right to the other side where well over 300 days for the GFC until volatility dropped below 20, we were able to generate over 1,800 basis points of return. So the key thing to take away from this chart really, Lance, is that periods of heightened volatility allow us to get paid more for doing the same thing.
Yes.
It allows us to get paid more in the individual trade, but also because we can deploy capital. But the duration of that uncertainty also has an impact in terms of the absolute quantum of returns that we can generate from the volatility risk premium that we exploit. So, COVID, 1,150 basis points to 1,800 basis points plus in the GFC.
You mentioned the important part there for me was a lot of other strategies in these conditions tend to raise cash. Mm-hmm. You see investors querying that. What is quite unique, of course, is actually we tend to lean in and deploy. And given it's intra-month, perhaps you don't mind me raising last week. So Tuesday last week, putting 5% of the cash to work in this environment. Perhaps we could even bring it to life with some illustrations. For those of you who know us, it might be a useful refresher, but for those of you who don't, maybe a good way to capture last week.
Absolutely.
Yeah.
So you're talking about Monday last week, just to be clear. So Monday last week, we were in a situation, given the heightened volatility and our fundamental bottom-up work suggesting that there was a number of securities that broadly, given where we commit capital, were trading at around about recessionary levels. And we were able to deploy that capital without a market timing, because I'll talk through the buffers and how much we were getting paid. And that's what allowed us to put money into the market rather than in that moment of maximum uncertainty in the recent past. And Monday, as measured by the VIX, meant that we had to hold off actually committing capital. So, I'd love to just talk you through that. We've got 2 illustrations here. Remember, every equity we own starts life as a put option, and we do that to reduce risk by selling a fully cash-backed put option. And in return for that, we get to commit to buy the shares at a lower price than they're trading at today, and typically in 2 months' time. And we get paid a premium, which, those of you who know us well, has generated about 520 basis points over the last 5 years of return, about half of the return over the last 5 years. I mean, we've done about 11.5, I think, per annum. So a little under, about half over the last 5 years. So in a normal volatility environment is what you're looking at here. So as it says on the left, volatility regime of 20, and the long-term average is a little under that, but not very far. Let's say that the investment team has done all our work on a bottom-up basis, through the annual reports and financial statements, and we've got our best estimate of the valuation of the security is 125. Rather than simply buy the stock at 100, we sell a fully cash-back put option, as I said, so make a commitment to own that share in 2 months' time. And in return for providing that commitment, we get to commit to buy it, in this instance, at $96. and we're paid a premium of $3. Now, 2 months, 3 on 96, call that 3% for 2 months. So you can see that'd be an 18% annualized rate of return. So 19 in absolute terms. So 3 on 96 times 6 gives you that 19% annualized return. And in 2 months' time, if the stock was to fall below 96, we would take possession of that. And of course, we would have an average entry price of $93 because the premium goes into the cost price, thus establishing a 7% buffer until any money is lost on the position. Okay. And we have done that in every single instance of the history of the fund. Okay. And that's what sets up this second lever of return, because if the stock's above $96, we keep the $3 of premium. Got it. Okay.
So now we enter a volatility regime of 40.
Yeah. 50 as it was on Monday. Yeah. Okay. So what we've done is we've put one together, exactly the same stock. Let's say that we think it's still worth 125. The stock's still trading at 100, but volatility last Monday was 50. Okay. Exactly the same stock, exactly the same valuation. Only thing that's changed is that the uncertainty in the market is represented in volatility of 50. What we're now able to do is we're able to sell a fully cash-backed put option with a strike price of $83. Same stock, we still think it's worth 125 at $83, and we're paid a $4 premium. So 4 on 83 is actually a 29% annualized return. And you can see that our buffer now is 3 times as great as the first example in a 20 volatility. We are not in a position where the fund or our investors will mark to market be anything other than positive in terms of the returns, as long as the stock in 2 months is less than 21% lower. Okay. So that is exactly the same security, trading at exactly the same price. We're doing exactly the same thing. It's just the simple difference between a volatility regime of 50 or 20. And I think this illustrates why we're able last Monday to put 5% of our capital, our investors' capital, to work at these annualized returns of between 24 and 28, 29%. So these two examples are illustrative, but the practical reality of last Monday was, pretty similar on several of the percent of the capital of the fund deployed, and that's why we did it.
And that doesn't manifest, looking back, that manifests forward.
Yeah, I understand what you're saying. So clearly the fund has produced solid and consistent positive returns, both in the Q1, but financial year to date. That is not a function of the volatility regime being higher. That is a function of the good security selection, frankly, from 9 or 12 months ago. Okay. It is, and I would go back, it is really, this is the go forward. Remember, so we've just spiked last Monday over 40, right? That, in terms of the teal line, is what subsequently was generated by the implementation process that I've just talked you through. So that's all to come if history is a guide.
Yes.
Guys, before we get to, if I just interrupt for a second, we've sort of 15 minutes to go, and I thought it might be worth hitting some Q&A because there's been some great questions come through from our listeners, and I think it'll cover off on a bit of portfolio as we do that. Is that all good with you guys? The first one came from Tom, and it was around any views on the A dollar versus the US, euro, pound, yen, and yuan over the next month or two.
In a word, no.
Yeah.
No, I'm not in the business of forecasting FX.
Understood. Tom also had a question around, we can probably go to the next slide, Lance. Your portfolio appears to be overweight pharmaceuticals. Is that still the case?
Mm-hmm.
And commenting on that.
Sure. So let's just go on to what you're looking at is the capital at risk in terms of by sector and by region. So this is the direct equity and any puts, so the commitment to buy shares. So 21% is in healthcare. About 18.5% of that is in pharmaceuticals, Tom. And not all of that, of course, is in direct equity, but just that's the capital at risk directly in pharmaceuticals. I guess the question is about the tariff risk. Now, there's a couple of things to say on that. It's a complicated clearly that's a risk. Secondly, it's reasonably complicated. There's really two things to take into account. If you have a look at someone like Sanofi that we've got exposure to, around about 50% of their US sales are manufactured in the US. Okay. If you apply a 20% tariff rate to Sanofi, that would impact year one earnings probably about, without any mitigation, in the low double digits. Okay, just straight through, if there's a 20% tariff on that, 50% of sales that aren't in the US that aren't generated by or manufactured in the US. Now, that's broadly commensurate with, Roche as well, albeit Roche has about double the number of employees. They've got about 28,000 employees, and their biggest research and development spend is in the US because of Genentech on the West Coast, right? So how does that play out? So that's a straightforward calculation we could do, Tom. But the second thing that's a little bit more complicated is that clearly to manage tax, a lot of the global pharmaceutical companies, and this is the transmission mechanism back into the US companies, use subsidiaries for the manufacturer in places like Switzerland or Ireland, which are much lower tax jurisdictions, and they do transfer pricing. So Johnson & Johnson would use their Irish domicile business to manufacture and sell it in at an inflated, relatively high price to the US subsidiary, thus having a low tax rate on the Irish kind of profits. Now, there's a range of tolerance within that. And of course, all the companies go to the top end of that to minimize their corporate tax rate. They could move to the low end of that, which would minimize, obviously, the level of tariffs that's associated with it because the dollar value is lower, but it would impact the tax. So that's the second complicated thing. What we've done to just put that into context, let's rubber hits the road into the valuation. If we assume a 15% hit to overall profitability for all our pharmaceutical holdings in year one, a 13% hit in year two, and a 10% hit then in perpetuity, okay, so really no mitigating circumstances, then effectively what that does is when we value the stream of cash flows off the existing assets, so the drugs that are patent protected, albeit this lower profitability, then we can sum that versus the overall value of the company and its liabilities to see the value gap, okay? And the range on those assumptions, if there was a 20% tariff in perpetuity and a 10% hit to overall sector profitability in each instance forever, would be the upside then on our positions would be between 16 and 64. So, for example, we've got Roche in the portfolio. It was around, that would still leave the valuation today at about 295, which is exactly why we sold some calls on the position at 295 earlier in the year to reflect the wide range of outcomes potentially in the tariff impact. So that is definitely something we're happy to speak more about, Tom, if you wanted to get in touch directly.
Great. Thanks, Hugh. Just to note, I think there's just some internet issues with a bit of lagging going on. So you guys, Hugh and Lance, are currently not visible on screen, but we can hear you fine. So we will press on. Just a quick one from Robert. Are you investing more funds in other gold stocks or gold streamers?
We have not. Newmont is one of the larger positions. You'll be able to see their materials is 8%. Now, that's really CF Industries, but it's also Newmont. We had exited the Wheaton Precious Metals, which have been a long-term holding in the fund, and our gold exposure is a combination of puts and direct equity in Newmont, which is the world's largest gold miner, and the majority of its deposit bases are actually in OECD countries. So we continue to hold them. They've been good performers. The valuation, that you're moving down the quality curve if you sort of continue to look at more and more companies within the gold space relative to our opportunity set. But I still think it's a sensible place to be, Robert.
Great. Thank you. If a position is in the money in the lead up to expiry, we're talking about options here, will you ever roll a position out and down, for example, or do you always take exercise of the in the money positions?
Pretty much always we would get exercise, but very occasionally in the history of the fund, we have rolled down because effectively the time decay in terms of the premium means that with heightened volatility, there's still the opportunity to get paid this 20% plus annualized return without taking possession physically of the stock. So broadly, I would say no, but it is an option when volatility gets high, and it is one that we have used in the past.
Great. Excellent. You mentioned, Hugh, earlier that obviously Talaria benefits from volatility when it's over 40, such as GFC, COVID, and aren't these times also good to buy equities directly?
Yeah, that's a great question. So historically, if you look at those 5 periods that we put up, as long as you've got some long-term horizon, and really, Al, I'm talking about 12 months plus, historically, that has always meant that equities generally have performed pretty well. So the implication is, well, why don't I just buy direct equity or cheap beta, right? Mm-hmm. The only thing that I would say is that history rhymes, but it doesn't actually doesn't exactly match. So if you think about the GFC and if you think about COVID, the Schiller PE, even in COVID, was about 25. We're 38 today. If you think about the Schiller PE in terms of 2008, 2009, it was 13. So to have a pari passu, a like-for-like comparison of vol 40, you need to go down 66% to be the same conditions in GFC, right, or you need to go down about 33% to be the same as 2020. So we would always come back to this idea of the cash flows, the return you want, and the cost of finance is the return that you're going to get, right? And of course, the valuation that you're paying it will define that in reverse. And at 38.5 times PE on a Schiller, that has never been a buying opportunity of any consequence on a sustainable basis in the US market ever.
Gotcha. Thank you.
So which do you want to balance? The 40, historical, VIX goes over 40, I buy, or do you actually premise, hey, what I pay for the asset is primarily what's going to drive what I'm going to generate long term? And we would always be the latter. Sorry to jump in there, Al, but that is absolutely critical.
Yeah, agreed. And one from Tom again, the large European banks are trading at single-digit EPS. You do not appear to think they represent good value. So do you think they represent good value, or are you seeing opportunities there?
Yeah, great question. Like one of the quite clear things here, when you look at the going back, Tom, to the sector exposure, financials is 7%. That is pretty much all in insurance. We've got a reinsurer, Everest Re, and we've had Chubb as well, which is a very high quality insurer. So you're right. We have not participated, despite the good return profile of the fund over the last 12 and 36 months, by owning banks directly, be that in the US or in Europe. Why? We work off a normalized returns framework, normalized cash returns framework. And if you look at all banks, despite seeing record bankruptcies in the US, seeing record levels of delinquencies in terms of moving, not foreclosing, but actually just carrying really pretty low underperforming loans, the loan loss provision is only about 50 basis points. Okay, so over a cycle, when it's cyclically elevated, that would be about 250 basis points. And whilst banks are better capitalized than we've seen historically, they're still 8 to 12 times levered. So if you think about, you've got a 100 billion market cap, you've got $1 trillion of assets, you've got that levered, as I said, 10 times. If that goes from 50 basis points to 2%, right, of the loan book, then clearly that's, a tremendous 2% of $1 trillion times 10. So that would be right there about 25% of your equity. Okay. And the second key thing is there hasn't been any loan growth. Okay. So the core driver of, what the business of banking is actually hasn't been driven by loan growth. And the net income interest margin hasn't been really growing as a result. So the fundamentals have been weakening and some of the costs are going up. What's been driving the banks is that this foreclosure hasn't been there. The regulator has allowed them to return more capital because of their strong position, and therefore they've been able to drive book value growth simply by buying back their own equity. But on a normalized framework, they can't be seen as anything other than over-earning. And therefore, we've stayed true to the level of our process. And obviously, despite being true to label of that process, the European and US banks have been very strong performers. Yeah.
Very good. Well, thank you. I think it's probably time to wrap up. We're nearly at full time. So thank you to Lance and Hugh, and thank you everyone for your attendance and engagement. You will receive your CPD point in the coming days. And as always, if you have any questions, please reach out to a member of the team. You can email us at info@talariacapital.com.au or the relationship manager that you already know. Thank you again and have a terrific Easter.
Thank you. Thanks for joining us.
Thank you, everybody.
Thank you.